Hey everyone, welcome back to 51%'s Crypto Research Podcast. I'm your host, Tom Shaughnessy. Today I'm joined by Carlos Domingo, who's the founder and managing partner at Spice VC and founder and CEO at Securitize. Our conversation covers security tokens, Securitize, and why Carlos believes the security token market across all of its metrics will increase by 10 times in 2019. We discuss the competitive landscape, and Carlos provides information on the competitive landscape for security token platforms, since we have so many today, ranging from Polymath, Harbor, TokenSoft, and others. Carlos unloads a ton of great information on virtually every aspect of the security token market, Securitize, and the future of crypto. As an aside, our podcast isn't sponsored, and we don't barrage our listeners with ads. Instead, we point listeners to our own work on 51pct.io, linked in the show notes below. 51% is a leading institutional crypto research provider. We distill tons of sources down to actionable deep dive reports on token projects. We recently released our security token report covering 4 major privacy coins, so you can get up to speed in half an hour versus endless hours of searching the internet. We're releasing our next report soon, which is our best yet. To celebrate the holidays, you could use coupon code HOLIDAY for a great discount on any of our memberships, but this coupon expires soon. With that, here's my conversation with Carlos. Hey everyone, welcome back to the podcast. Today I have on Carlos Domingo, the CEO and co-founder of Securitize. Carlos, how's it going?
How are you doing, Tom? Thanks for the invite to the podcast.
Yeah, it's great to have you on. So Carlos, let's just get a bit about your background and how you got started in crypto.
Sure. My background, I'm originally from Barcelona, from Spain, but I've been living like half of my life abroad. I spent the first years of my career in Japan. I have a PhD in computer science, and I studied at the Tokyo Institute of Technology. I was during the dotcom times in the early 90s, part of a startup that did an IPO in Nasdaq Japan. Moved to the US, went through the downturn of the dotcom, which sounds very familiar. What's happening these days as well with the company we acquired in the US, and then in 2006 I was recruited by a company called Telefónica, which is a very large international telco, originally from Spain, to kind of start their digital operations after the dotcom crash passed and the internet was picking up again. And I was fortunate enough that in 2007 the iPhone came up, so there was a lot of excitement and activities during in the mobile space those years. So those were years of a lot of activity at the company. And then 4 years ago, I got an offer to move to Dubai in UAE, working for a smaller telco there, the local telco called Du. And as part of the work I was doing there, we won the project for building the main platform for smart cities. For Dubai, is a project called Smart Dubai, which is very high profile and very ambitious. And as part of that project, we started looking at together with some government agencies about some new technologies. And there was something they created called the Global Blockchain Council to advise the government on what to do with blockchain, which led to a strategy you might have heard of, Dubai trying to have all the government transactions on the blockchain by 2020. And I got excited about the space. I thought that, after being 10 years of my career, and when we find out this was, May, June 2017, so almost a year and a half ago, is that there was no interest in security tokens at all. Everyone was focused on utility tokens. It was at the peak of the hype of ICOs and, doing unregulated offerings, selling to retail investors, being able to list quickly the tokens and flip them for a higher price, etc. So we couldn't find any company on the space that was focusing on security tokens and had already technology built that we like. So we decided to basically hire a CTO, Shai Finkelstein, and some engineers, and built our own tokenization platform for Spice VC, with the idea of issuing the token on the blockchain and providing all the compliance layer using smart contracts. So by the time we went public with the project in around September-October timeframe, the market had shifted a little bit. So the SEC had already issued the famous DAO report, saying that the DAO ICO was in fact a securities offering. And more importantly, there were some people like Stephen McKeon, who I contacted back then, who were talking about how there's a bigger story than making ICOs legal with security tokens, but it's about digitizing securities and providing a lot of advantages to traditional securities, whether they're private or public. So at that time, we realized that we were sitting on something that was very powerful, and that the market was going to shift towards security tokens, and security tokens were going to be a thing. So we decided to spin out the technology platform that we developed for our own fund, SpiceVC, as a separate company called Securitize. And we launched it in January, and then in March I became the CEO and moved into the project full time.
That's a great story. You definitely have a ton of experience here, Carlos. That's why I wanted to have you on for those who are unaware. But before we jump into what Securitize does in more detail, I'd love to get your take just because it's relevant. You went through the dot-com bubble. How do you feel today in crypto versus the dot-com bubble? Was it as bad back then as people are kind of saying crypto is today?
Oh yeah, the dot-com bubble was very bad. I think that the difference is that it was a longer process, right? It took more years to go up and more years to go down. It was not as drastic as what we've seen just in the space of 2 years, going up and going down. But back then it was very bad. The company I was working for, lost 80% of the market cap. Most of the companies, etc., they also lost like 80-90% market cap. In our case, it was even worse because we were publicly traded in Nasdaq Japan, and which was spun out of Nasdaq to basically IPO dot-com companies in Japan. And Nasdaq Japan actually closed down. They shut it down because there was no more demand for this type of services anymore. So, and in the US for 3 years, it was very bad. It was very difficult to do business. A lot of people left the space. What had been a great thing to be an internet company or a dot-com company suddenly became like a bad thing and a bad image. So, but eventually recover, and I think this is what's going to happen here as well. If you look at the companies that were back then in the space, like Amazon today, you barely see this 90% drop that they did in the late 90s, early 2000, because they've grown in the last 20 years so much and they've created so much value that is something too small to even notice it. So I am a firm believer that this is exactly what's going to happen now, and that especially during the downturn of an industry, a lot of the bad projects and the bad actors totally disappear, and then kind of clean ups, and only the solid companies that are really building something that has value will stay.
That's great, caller. I definitely agree with you, Carlos, that we have a future here. So let's go back into Securitize. It always struck me as kind of interesting that your origins were kind of to tokenize SpiceVC, and then for those who have followed me, one of my first episodes was with Polymath CEO, and his goal was similar to tokenize a fund, basically. I have to ask, do you think that, I know that your platform is very different from Polymath, but is your focus basically to securitize funds, or is your focus to securitize any digital asset moving forward?
No, we're pretty agnostic, and I'm convinced that the technology itself is agnostic. We started with a fund, and as opposed to Polymath, we actually did tokenize the fund and did issue the security token on the blockchain, and have now listed it for trading on a regulated security token exchange. And I think that actually building a technology to solve a problem, gave us a head start against everyone else. And obviously, because we tokenized a fund and became known for that, we have been doing many other funds, and we've also been moving the early funds that were tokenized prior to us existing, like Blockchain Capital or Science, into our platform as well. And those early tokens are now issued using our compliance protocols. So we obviously became good at doing that, and we knew how to do it. And a lot of people reach out to us saying, "Oh, I just want to do the same thing with SpiceVC did, but for a different context, a different industry, a different focus on of investing." But what I came to realize after being here for a while is at the moment, the security token space is still nascent, and most of the projects, the type of technology they need is very, very similar. Obviously, I think this will change over time and it will become more specialized and more complex. But at the moment, they're just simply, wrappers around, security. And it's the same whether you tokenize a VC fund like SpiceVC investing on blockchain technologies versus, we've tokenized also a real estate fund that is investing on real estate assets. But at the end of the day, the process and the technology and the regulatory framework is exactly the same one.
That's interesting. So let's go into, I've had a lot of conversations for those who follow the podcast, so I don't want to rehash all of the benefits of security tokens while I have you. But after all my conversations, one of the main ones that I found is basically just the fractional ownership. So, reducing the illiquidity premium and that would be something like, making the Yankees into 50,000 token ownership stack, something like that. Mm-hmm. If you had to pick, one or two key aspects, what do you think has come up to be the driving force behind the need for security tokens or digital assets or digital asset tokens, whatever we're calling them at this point?
I think today what most of the projects look after is basically two things. One is capital formation. They see security tokens as a kind of like crowdfunding on steroids, where they can actually do an offering on a global basis and control, how you onboard investors from 40, 50 different jurisdictions and how you manage them moving forward. Something with traditional technology will be much more challenging. And the second one, obviously, is liquidity. Everyone that is doing security tokens today, they're doing it because they believe that the security premium will be there and that will attract more investors precisely because the underlying asset is liquid. And I think one of the reasons ICOs were popular is precisely because of the liquidity, right? The retail investors cannot invest on something they cannot, move for a long time. And the problem with venture capital firms precisely is that as an asset allocation is always very small because of the illiquidity of the underlying asset. So I think capital formation and liquidity are what most people are, looking after. The one that they're not requesting, but I think is going to become very important, is everything has to do with automation of managing the life cycle of the security. How once you become liquid, you can automatically reconstruct the cap table and have the cap table in real time, back to the issuer, even if the token is trading in multiple places. How you can automate, payouts, communication with investors, conduct proxy votes, and things like that, which is typically quite challenging when you have a big cap table. Private companies usually have small cap tables. In the US, the average is 35 investors. But the moment you do a capital formation in a broader sense and you start trading, then your cap table balloons in terms of size, and all these things that don't seem to be important today, they will become important in the future. And with the more mature projects that we are managing, like SpiceVC or Blockchain Capital, we have started to see how they have now started to realize about the importance of this second part, as opposed to the, let's say, capital formation and liquidity, which was the initial requirement.
That's super interesting. So I always thought that, I think that everybody's gearing up for security tokens to be a huge aspect of 2019. But in my mind, security tokens, digital asset tokens, they're more of a help to real world assets than it is help for crypto. Do you have any thoughts here? Because I'm trying to push back against people that think like security tokens are going to, drive the next bull run. I just don't see how it would happen. But I also think it's great for the companies involved and great for the real world assets.
I absolutely agree with you. I think I'm pretty much against the view of, security tokens are kind of like the next evolution of ICOs, and but legal, because I think that's an extremely narrow view of the space. First, I think that with security tokens, the craziness that happens with ICOs will not happen for a number of reasons. You will not see all these pre-sales with discounts and things like that, because you can't just print money as the utility token people used to do. And second, the liquidity will be much more limited than the liquidity that the ICOs will get. So obviously these jumps in prices, etc., will not happen there, because there's an underlying asset. So it's a reference to the real value of the what you're buying, the token you're buying. So I think that the interesting thing for me is basically how security tokens, or as we prefer to call them, digital securities, are just a better way of digitizing securities using blockchain technology, which has advantages for both private securities and private placements, as well as for publicly trading companies, which no one is thinking of, but to me it will be the interesting thing. So 2019, I think it will be the year that really security tokens start becoming a thing. This 2018 has been very, very small space. In 2017 that we could track, there were only 3 projects, Blockchain Capital, Protos, and Science. And in 2018, we haven't been able to actually track more than 10 real security tokens. So security tokens that have actually issued a token that there's an asset behind and that there's a company behind, etc. In spite of the claims you can hear out there, there's lots of projects, lots of startups entering the space, but nothing really has happened. And the proof is that Open Finance just launched in the US, and so far it's only trading 2 tokens, Blockchain Capital and SpiceVC, and we're going to be listing 3 or 4 more tokens down the road, but they're not going to be listing like 100 tokens, because there doesn't exist 100 security tokens. I think 2019 we definitely see a 10x improvement in the number of security tokens out there. So we'll go from like 10 to 100. We'll also see a 10x increase in exchanges from 1 to 10. But that's still a tiny market, and it's never going to be as big as the crypto market was, or how the real market, of private placements or publicly traded companies. It will happen, but it will take a lot longer than just 1 year.
Yeah, no, I think that's a great way to word what's going to happen in 2019. I think that in essence, security tokens could be a larger asset base just because the assets are so large in size and they're global. But to think it's all going to happen in 2019 is just hard.
Yeah, definitely. It's definitely a much bigger asset class. I mean, if you think about private placements just in the US in 2017, there were 40,000 private placements. So just in number, it's much bigger than the amount of ICOs worldwide. But on value, the total aggregated value of those private placements, according to an SEC report that was published 6 months ago, is $1.7 trillion. So that's major. You're talking about trillions. You're not talking about billions anymore. And of course, that's not going to be tokenized tomorrow. But just if 10% of those gets tokenized within the next 3 to 5 years, you're looking at $170 billion just on the US, potentially, moving into security tokens. And if you think the US is maybe like 1/3 of the world, then you're looking at maybe 3 times worldwide. But it's not going to be in 1 year. The industry is still extremely immature. The underlying blockchains are immature and have a lot of problems that they need to fix. So our view is that it's going to take more 3 to 5 years than just 1 year.
That's interesting. So, what is the total size of the security token market that you think? I know you just alluded to the number. I just wanted to get a somewhat of a ballpark figure that people could run with here.
So if you look at the private placement, as I said, our estimates, so we have the number from the US because there's this great, as I mentioned, SEC report about Reg D and private placements that has a very detailed analysis of how many they were done in 2017, and the number is actually growing because the private markets are becoming bigger and the public markets companies are staying private longer than 20 years ago, and the number of publicly traded companies has halved since the dotcom times. So the private market is a good reference of size, and it was $1.7 trillion in private placements in 2017. So it's probably like $2 trillion by now, by 2019. And assuming the US is only, let's say, 1/3 of the world in terms of economic importance, then you're looking at probably $6 trillion. Now, that's not going to be 100% tokenized, right? I think that a lot of those private placements don't make any sense to be tokenized. They're too small or too early stage, etc. So assuming that maybe, let's say, 10% of that, $6 trillion get tokenized, you're looking at a $600 billion market for security tokens. Now,
wow,
that's a simple math. So it's just talking about private placement. The other side of there's a bunch of other assets out there that potentially could be tokenized. I think that the big one is real estate. So real estate assets worldwide are around 250 trillion. So you're looking at an entire different ballpark and order of magnitude there. So if 10% of the real estate in the world will get tokenized, then you're talking about $25 trillion, which I think probably won't happen. So with the excitement over real estate, it will probably be smaller, especially now that the interest rates are going up. I think people are going to lose a little bit of interest in real estate. But then the other interesting part that people don't understand is about the public market. So the public markets, even though they're smaller, they're still quite big in terms of the number of transactions happening, right? Because there's a lot of people, buying shares and stocks every day. We went from, in the US in the 70s, there were like 10, 15 million shares being traded per day to like close to 1 billion shares traded per day today. But the value of those trades is like on the quadrillion. And that's obviously, not, what we mentioned, the industry will be like a fraction of that, like a very, very, very small percentage of that. But you're looking there at potentially a huge application for security tokens, which is a bit different than what people are seeing today in terms of like, doing an offering, raising money and issuing a token, but basically providing a better way for dealing with, publicly traded securities.
That's awesome. So Carlos, let's walk through, I'm interested in 2 metrics regarding your real estate example. The first one is a lot of people talk about the illiquidity premium. So, having security tokens in smaller bunches could increase the total price of these assets because you don't need one buyer, you could have 1 million buyers. And the other thing a lot of people talk about is the fees within the existing market. So I'm also interested not only in what you think the illiquidity premium is or could be, but I'm also interested in, where you think the fees will go. I don't know, is it 5%, 6% people pay to invest in real estate today and closing costs, et cetera, that'll go way down? Or I'm always concerned about where the fees will go.
Okay, so first, in terms of the liquidity premium, that's definitely one of the huge advantages of fractional ownership that security tokens bring to market, right? So I always use the same example when I speak. It's like if you have, for instance, a paint from Picasso, the Spanish painter, and it costs like, let's say, $5 million. You need to find first one person that has $5 million to spend, and second that likes Picasso, right? So the likelihood of you finding that person is extremely low. So either you keep the asset for a long time, it takes a very long time to sell it, or you have to depress the price until you find a buyer. I think and eventually, obviously, as you depress the price, you eventually find a buyer because there's lots of people that like Picasso there, but there's not that many people that like Picasso and have $5 million. So fractional ownership, as you mentioned before, it kind of solves this problem, right? Because you don't need to find one person that wants to have, an economic interest on a Picasso and own a portion of it, but you find, 1 million people that want to put $5 or less people, but with a little bit more money, and then suddenly it becomes easier to form the capital, and therefore you avoid reducing the price of the asset to find a buyer. In the from all the research I read, the estimate for something like real estate, which is not entirely liquid, I mean people buy and sell real estate, is around 30%. So there's a potential 30% premium that liquidity can bring to a market. Or if you can see it the other way around, is potentially like a 30%. You don't have to reduce the asset to sell it when you need to sell it, because you can just sell it in bits and pieces. So I think 30% is probably accurate. But when you move to things like shares of companies, I think the premium could be much bigger. I'm aware of certain security token projects that are looking at doing something very clever, which is to buy shares from private companies from VCs that are trying to close their fund. So let's say a VC has a 7-year fund, so it's investing for the first 5, and then it has 2 that needs to liquidate. And because these days companies stay private a lot longer, it can't actually shut down the fund because it's sitting on shares of companies that have not exit yet. And then if the fund is doing well, let's say the fund has returned 2 or 3 times the capital, the VCs have very little incentive to be sitting on those shares, and they prefer to liquidate them. And the premium, from what I'm heard, it happened on the secondary market, could actually be much bigger than 30%. It could be even 50% or higher, especially because no one knows exactly how to price a private company except for the reference of the last funding round.
That's insane. So, that's much higher than people think.
Yeah, but that's what happens. So people, suppose you are an early stage investor in Uber, and you've invested in Uber. Today, 20 years ago, if you had invested in Uber at the very beginning, Uber already will be a public traded company, right? So you can just go and sell your shares there. But Uber hasn't done an IPO yet. There's rumors that maybe they do it next year. So there's kind of an active secondary market for Uber shares or Airbnb or other things like that. And then the guys that invested at the very beginning, their multiple is so big that even if they discounted 50% from the current price, they're still making a lot of money. But at least they can actually get out and get liquidity. So this is why those discounts are so big, because for someone that is doing a 50x, even if you reduce by 50% the end price, you're still doing a 25x, and then you get your cash and you can do something else with it, as opposed to just sitting there and waiting to see what happens and see whether the company actually goes public or not, or something might actually happen and the company starts like underperforming and the price of the asset goes down. So I think a lot of people, when they've made enough money with an asset, they're willing to sell it at a discount just to get the liquidity.
Yeah, it's interesting. I mean, a lot of people in crypto, switching over to the crypto side, kind of argue that same idea about early stage founders in these projects that just have massive stakes that are maintained through all of these forks and everything else.
Yeah, it's actually good. It's not a bad dissimilarity that, people are saying, oh, who could be selling, Bitcoin today at, $3,000 or $4,000? Well, someone got it at at $10, for them, they already made a lot of money. So of course, selling at 20,000 will be much better, but you're still making so much return that you're willing to sell it at a discount to be able to get the capital and put it somewhere else or do something with it. So.
That's interesting. So Carlos, I'd love to learn more about, you guys have the Securitize platform and you also have platform services. So, in my mind, when I'm thinking about security tokens, I always have this, internal roadmap. I think of Polymath on one end of the spectrum where it's a very scalable type platform where anybody can go create their token. And then I think of Harbor on the other side where Harbor centralizes compliance and they're really legit and they're focused on professionals, et cetera. So I'd love to know more about where Securitize fits in the competitor roadmap. And if it makes sense to just explain the platform first, that might make more sense to listeners.
Sure. So we do have an end-to-end issuance and lifecycle management platform that includes, a blockchain protocol for actually issuing the tokens and providing the compliance. So we basically have tools for anyone that wants to do a security token offering, to do KYC, AML, and accreditation for investors coming from multiple jurisdictions. So we have around 40 jurisdictions that we kind of cover. And then also the tools to manage that process. Like what people don't realize, and I went through this with the SpiceVC, is that when you're doing a security token offering, you suddenly have hundreds, if not thousands, of people that register there, that request this, request that, look at the documentation, but don't sign the subscription agreements, or put money, but don't register a wallet, etc. So this is not something you can just manage with an Excel sitting there. So we've ended up building a lot of the tools to manage the investor process and the investor onboarding, as well as to be able to collect funds from them, either crypto or fiat. Obviously, with partners, we don't actually collect the money ourselves. Being able to issue secure wallets, being able to verify that you control a wallet, so we can then send you the tokens, etc. And that's on the, let's say, security token issuance side. And this is just a platform on top of the blockchain, but it's completely off-chain if you want. Now, once we are ready to then issue the tokens, which in some cases the fundraisers have happened using our tools. In some other cases, let's say like Blockchain Capital or Oakmate. Oakmate just did the fundraise on their own, and then they just basically send us the list of investors with all the data. So we will create the token for them. In the case of Blockchain Capital, they actually had done the fundraise with some other company, and then they upgrade the contract and move into our platform. So we need to be able to collect all this information about all the investors that are going to be receiving tokens. And then once we have that, we then create the smart contract that represents the token, as well as the other set of the smart contracts that control the compliance of the token. And collectively, we call this set of smart contracts the Digital Securities Protocol, which is basically a protocol to manage digital securities. Once this is issued, this is where really the beginning of the life of the security starts. And that's what, a lot of people don't understand it, that this is not a platform that only does that, issues a token. It's just not useful for someone that is going to get the token traded on an exchange, because then you need to work with that exchange to integrate your compliance protocol there. But you also need to be able to integrate with them, that they send you information about the investors back into the platform, so you can reconstruct the cap table for the issuer. That investor needs to be onboarded. There needs to have a place where they can actually go and log in and see its investor dashboard with its information and receive communication from the issuer. You need to be able to have that to conduct like proxy votes if there is any governance involving the security token, payouts in case the security token pays a dividend or the company at some point in time gets sold, etc. So from that perspective, I think that probably Harbor is looking at building something a lot similar to what we've done, but very verticalized for real estate, at least from what I've seen on their current portal, even though it's just more focused on the fundraising side of things, and they only have one project. Polymath is entirely different. So if you go to Polymath, you go there, they have the Polymath studio where you have to create a token, but you have to basically upload an Excel with all the information about the investors, and that's it. And how you got that information or how you came to that point in time is completely, not part of their offering. And then once you want to issue the token, you have a set of parameters, and that's it. And that's what you can do or not do, unless you know blockchain and you can modify the contracts yourself. What we will actually build the smart contract completely customized to the rules that the issuer wants to tell us, which in experience is very complex, and it also changes from issuer to issuer because there's a bit of a gray area in terms of compliance in this space, and every lawyer has a different interpretation. And in the case of Polymath, again, the moment you click the button and you issue a token, that's it. There's literally no other tool to do anything and manage the lifecycle management of the security. And if it's an issuer, they will have to build those things on top of their protocol. The other thing I think we're probably closer to hardware and different than Polymath is we do sign contracts with our customers where we provide SLAs, where we provide, clarity instead of exactly what services we do, where we, agree on what are the regulatory compliance that we're going to be coding on the smart contracts and commit that this is done that way, so etc. So it's a proper legal relationship between the issuer and us in terms of us committing to what our technology does and what does not. In the case of Polymath, you have to buy the utility token, just go there, you pay with that in their own payment token, and that's it. So a lot of our customers that come to us, they just think that, there's not enough guarantee of anything that happens there. There's no contract or no binding relationship with the company. On top of that, you have to use a utility token that, was sold as security. So probably that might lead to problems in the future with SEC, given the current climate, et cetera, et cetera. So we tend to see ourselves more, closer to hardware, but with a more, let's say, more, broad and horizontal approach to try to tokenize any type of assets and also provide the lifecycle management and not just the offering.
That's interesting. So I guess my takeaway from all that is that since this market's developed, these people businesses that want to launch security tokens have realized that it's not just a launch and forget. They actually need the compliance and they need the lifecycle management as it's ongoing. So I guess I'm interested on the compliance aspect and the lifecycle management aspect. I mean, are these, I guess specifically on compliance, is this something that you were approached for that you needed to implement, or is this something that regulators approached you with that you had to then implement? I'm wondering, why such a big a focus on compliance?
Well, so what you're issuing are securities, right? So you need to make sure first that you are onboarding investors to purchase this security in a compliant way, depending on the jurisdiction where the investor sits. And second, there are rules in the secondary market for how these securities can actually trade or not trade, and at what point in time, etc. So as we mentioned at the beginning, we started fixing our own problem, which we wanted to do a security token offering for SpiceVC. So at that time, we as the issuers were the ones having the problem of making sure what we were doing was legal. So we went to a number of legal firms and told them, okay, this is what we want to do, and we're bring investors from here and from there, and we want to do this, and we want to be able to then trade the token here. And then we kind of built this library of know-how about unregistered securities, which is the case for all these security tokens in a number of different jurisdictions. Then once we move into Securitize, is the opposite. Securitize is basically the supplier for the issuer. We're not a law firm, so we don't provide legal advice, but we already have built all this, know-how about, the different rules and restrictions, etc., and that those are built into the platform. So basically, offer this to the issuer, but it's at the end of the day, it's ultimately their responsibility with their legal firm to review everything we give them and give us the green light, and this is what we end up implementing on the smart contracts. So the desire to do this comes, primarily from the issuer, right? Because he's the one that has to make sure that if you issue a security, you do it in the right way, and if it gets traded, it's traded in the right way.
No, that's interesting, Carlos. I guess my question more specifically though is, has anyone who's looking to launch a security token approached you guys and said, we like your compliance features better than another security token issuer? I'm just kind of wondering where the compliance landscape is for security token issuers.
Well, so I can't speak for hardware because they just launched one project and our token they published many months ago didn't actually contain any compliance rules. But I can tell you that in the case of Polymath that you mentioned, at least with the studio, which is like this UI that they have to issue tokens, there is a lot of compliance rules that our customers are requesting us that you will not be able to implement for sure, because there's no UI there to put the settings. Of course, I'm assuming you can contact Polymath and they'll customize and build whatever you want for them. But in our case, for our customers, basically, they want to have very, very specific rules, and they know that, our protocol has enough flexibility to be able to deal with those. And that is also upgradable. So in other words, once we issue a protocol, if for any reason we need to change something or modify something, we can actually do it. Because the way we've issued the smart contract and the technology we use allow us to change these rules as per the request of the issuer. So definitely having that, know-how as well as flexibility in the protocol to be able to implement complex compliance rules is definitely a competitive advantage.
That's awesome. So going on to the lifecycle management, I mean, that's a huge benefit for you guys. Do you think that this lifecycle management portion of your business can grow and evolve in new ways? Like, I'm just trying to think, like, if we tokenize it, like, let's say a building, like maybe those building owners who own tokens want to get, the net income of the building distributed to them via airdrops or something like that. Is there more to the lifecycle platform in the future, or basically do you have everything you need now?
No, we don't. Actually, that's you're absolutely right. I think that this is where I think we can, people are not requesting it today because everyone is focused on, okay, security tokens, let's fundraise with a security token and let's try to provide liquidity. They're not conscious about all the other issues that you're going to have to deal with once the security is issued. Simple ones like, at the end of the year, you have to, file tax certificates for your token holders. So you actually need to know who they are, right? So unless you integrate with these changes in a way to reconstruct the cap table, you will not be able to actually do that. Or you might have to, have some reporting requirements on who your shareholders are, make sure there's certain limits that are being covered, etc. So today, I think we do the basic lifecycle management, and it's enough for the customers we have today. But as I mentioned, the more sophisticated and advanced customers that have been out there for longer, like Rockchain Capital or Spice, are the ones that are kind of started to demand more and more of these features for lifecycle management. And for us, it's actually a great thing because it allows us to build recurrent revenue. Because basically it means the platform doesn't go away the moment you issue a token, but the platform needs to stay there to continue providing all these tools for managing the lifecycle of the security for customers. So we build over time a recurrent revenue stream as far as any of the issuers that we're dealing with have, issue successful securities that stay in the market.
That's super interesting. So, Carlos, let's go on to some, recent news items and stuff that you guys have been doing in the market today. You guys had a lot of news around your token transfer I believe it was on Ethereum through AirSwap. Could you walk us through what happened there?
Yeah, so we did two test transfers, if you want, now with Open Finance and with AirSwap, and actually Open Finance went live last week with that. So basically, what we have done with both companies is the following. And both companies are different. I'll mention the differences in a second. But basically, if you issue a security token using our compliance protocol called the Digital Securities Protocol, we actually control, implement on the smart contract a number of transfer restrictions. So these tokens are, if you want, standard ERC20 tokens, but we've added a number of, additional calls to them, and more importantly, we've actually modified the code of the transfer function. So every ERC20 token has a function called transfer that is the one you activate if you want to move the token from wallet A to wallet B. Okay, and if you have like a regular ERC20 from, let's say, a utility token from an ICO, there's no transfer restrictions because this is, it's supposed not to be a security, even though it's probably a security, but it was sold not as a security, and therefore the issuers did not implemented any transfer restrictions. In the case of securities, there's tons of transfer restrictions. There is transfer restrictions of, this group of customers or investors cannot move to these other ones. There's transfer restrictions because some investors cannot actually, transfer the security for the first year. There is restrictions because you can't go above certain limits of the number of investors, et cetera, et cetera. So we basically have, built these restrictions and these rules in the protocol in a way that we can actually let these changes, in this case, Open Finance or AirSwap, to check at a particular point in time whether a transfer can happen or not happen. So the way it works is basically, they will onboard two investors, one that holds tokens, which we definitely will know who they are because that is already registered with us as a token holder, and another one that wants to buy, which is not registered with us. And then we have a way for them to insert the what we call the non-personable identifiable information of the investor into a registry where we keep a list of investors on the blockchain. And this non-personal identifiable information is basically enough for compliance purposes. So it basically contains your jurisdiction, the jurisdiction of the investor, contains things like the accreditation status and expiration date, the KYC status and expiration date, AML checks and things like that. And then at a point in time, they can actually check whether they can actually transfer the token from A to B. And then we will apply kind of automatically in a decentralized way, if you want, on the blockchain, all the compliance rules that have been implemented for that particular issuance. And you will look in real time at what the cap table is. You will understand all the restrictions there are in terms of limits, flowbacks and, this and that. And then you will just tell the exchange, okay, go ahead and execute the trade. Or no, this trade, you can't execute it because you're basically, selling from a Reg investor into a Reg investor, and that's called flowback, and it's prohibited in the US. So things like that. So both integrated our compliance protocol to be able to trade tokens. Open Finance, as I mentioned, is already live. So you can just go there, register, and you can see there's 2 tokens traded. They are all powered by the Digital Securities Protocol. And every single, trade that happens there gets approved by our protocol according to the sets of rules that we have agreed with the issuer. AirSwap is a bit different. So Swap is not a full marketplace. It's a bulletin board. So basically an investor can go there and say, okay, I want to trade this token. There's no price discovery like you have an exchange. There's no book building or anything. And they basically, if another investor is interested in buying these, they're both onboarded into AirSwap by a broker. And then AirSwap basically creates a channel for those 2 investors to communicate. And also it checks whether the trade can happen using our protocol. And once they agree the price, then the transfer happens peer-to-peer between those 2 investors.
That's super interesting. So I guess one of my questions there is, how hard is it to police, I guess the first question is, how hard is it to onboard users to this KYC AML platform? And I guess the second question is, how strong are the restrictions that are imposed on these token holders? Like if I pass all the checks and I'm able to buy or trade the security token, is it hard? Or is it, set in stone that this user can't transfer these security tokens to another user?
Well, so this is software, right? So these are smart contracts written into the blockchain. So once we have written the rules and issued the tokens and the smart contracts on the blockchain, that's it. That's what prevails. So whatever those rules do not allow, it doesn't happen, and it will not happen. And that's
Carlos, stepping back though, that's awesome. But how hard is it to pass all these KYC AML checks prior to that software restriction?
And KYC is for the most part is automated, KYC and AML. Sometimes it will fail for whatever reason, like someone might register as Jim Martinez, and then the name of his passport is James Martinez, and then you will actually not match, and then someone has to manually go and take these things, etc. But as far as you submit a clean copy of your passport and it's a real one, and it matches the information you submitted, then KYC typically could be passed. Accreditation in the US is a bit more complicated because you have to submit documents that have to be reviewed by a lawyer and an accountant. So there's a manual process involved there. So it doesn't happen overnight. In other countries, it's easier because it's self-accreditation. So you basically have to reply some questions, and then it's your responsibility to be truthful to what they're being asked you to then qualify you as accredited investor or non-accredited investor. So it's not a very difficult process itself. It also depends on the backlog that the exchange has, on how strict the compliance rules are, how many people they actually have in the compliance department, and things like that. Now, once you've passed that, it doesn't necessarily mean that you can actually buy the security, right? Because there might be certain restrictions that prevent you from having the security. So I don't know. For instance, if you're a US investor today and you are trying to buy SpiceVC tokens, you will not be able to buy them because SpiceVC tokens were issued under Reg D, and therefore there's a 1-year lockup. And this 1-year lockup, hasn't passed yet, and you're not able to buy tokens from someone that bought it on the Reg S, which means foreign investors, non-US, because we control flowback. So the tokens don't flow back from, let's say, UK back into the US illegally. So even if you're accredited and you pass KYC and everything, the compliance situation of that particular token will not allow you to actually buy it. So yes, it's complex, and there's a lot of rules and a lot of nuances. But passing the KYC and the AML and the accreditation is usually not the problem.
That's interesting. Yeah, no, I know the software always prevents the trading of tokens and accounts that shouldn't have them, but I always was curious on how easy or hard it was to actually pass those tests. But That's interesting info. So Carlos, moving on a bit, one question I have, I know we're really early in the space, but I'm always interested on, where companies make money and how competitive they are. Do you ever have any problems attracting clients based on what you guys charge or price versus your competitors? And do you think that these costs are well below traditional costs?
So our cost is is pretty reasonable, I think. Of course, that's my own opinion, but usually price is not a problem for what we do. We don't go to very small issuance. So if someone wants to raise $1 billion, $5 million, we usually tell them, you shouldn't work with us and security tokens are not for you. I think costs will come down over time as the technology gets better and there is less manual work involved. At the moment, I think they're reasonable and it's usually not the problem to work with us. And we are probably the cheapest part of all the costs involved in the process, right? So legal usually is a much bigger cost, even though we're working with few law firms to try to kind of standardize the legal documentation required and making it cheaper. But then the other cost is fundraising, right? So if you're doing the fundraise yourself, there's no problem because it's zero cost. But if you're using broker dealers, they tend to be more expensive, and they usually charge a transactional based compensation. So the bigger is your project, the more money you have to pay them. Many of them require a retainer, etc. So I don't think that we are kind of like the problem there. But in any case, if you compare the cost of like doing an IPO, which will be the alternative for you to basically fundraise this way and provide liquidity to your investors, we've done a lot of case studies to measure that, and security tokens are going to be a fraction of it for sure. Not just on the issuance part, but also on the maintenance of the security over time.
That's interesting. So, I mean, on the stake of money, or on the conversation of money, you guys raised, I think, $13 million recently. I believe it was through through Coinbase and Ripple.
Well, there was a lot more investors. So Coinbase Ventures and Ripple, through their Xprin brand, participated. The lead investor was Blockchain Capital, and then we have another smaller funds that also participated on the round. Not smaller, but company like NXTP from Latin America, Global Brains from Japan, OKCoin, which is one of the largest crypto exchanges now moving to security tokens, also participated. We got a very good set of investors.
No, that's interesting, and congratulations on that. I know that's only 2 or 3 weeks ago. So I guess my question there is, I know it's a lot of money for you guys. If for some reason, let's say security tokens take longer to uptake, and let's say for some reason Securitize fails, does this have any impact on the security tokens that you guys help launch, or can the system persist with or without you guys?
That's a very good question. So the smart contract, once it's issued on the blockchain representing the security, we make sure that the issuer has access to the keys, so they can always manage it themselves. So they don't need to continue working with us if they don't want to, and they don't need to do anything. So the security itself, or the digital representation of the security on the blockchain, is irrelevant of whether we are in business or not. So if we disappear tomorrow, that will still be there and will run on top of the Ethereum blockchain. As far as the Ethereum blockchain also doesn't go out of business, then there's no problem. Now, the services we put on top of it with the platform, obviously that's been maintained by us. So that will go away if we disappear. So an issuer in that case, and I hope it doesn't happen, we'll have to find a way to interact with the smart contracts on the blockchain, or someone else to build something on top of it, because the tools that we provide to do that, which do not require for you to know anything about blockchain or understand blockchain, are not going to be there, because obviously that's maintained and hosted by Securitize. But anything that has to do with the security itself is basically a decentralized protocol issue on the blockchain, which is managed by a multi-sig contract where the issuer has access to the keys to be able to continue doing it themselves.
That's super interesting. And Carlos, I get a lot of questions from people I talk to in the space, and they're always wondering, why some security token companies purchase broker dealers and why others don't. I'm wondering your take here. I think one of the most prominent ones is Templum buying a broker dealer. I think it was last February. But I'm interested in whether or not you have one, think you need one, and what this enables you to do differently.
So yes, a lot of people buying broker dealers, like Templum bought a broker dealer. Stonesoft recently announced that they invested in a broker dealer. It just depends on what part of the value chain you want to play. We don't want to be playing on the fundraising side. I think Harbor also bought a broker dealer, if I'm correct.
I think they did.
Yeah, so we don't want to be doing fundraising. I think that there's plenty of people doing fundraising out there. Just by adding another broker dealer doesn't add any value add in the industry, in my personal opinion. And it also adds a huge, compliance burden to the company that we feel will not let us go as fast as we go today. So we take a very conscious decision of not buying a broker dealer, but partnering with as many broker dealers as possible, just to be able to send them, the issuers. We obviously don't touch that part of the business. We don't charge a transactional-based compensation like broker dealers do. We don't, take any fees or commissions from them. We are strictly a technology company that provides all the tools for an issuer to be able to, carry on with a security token offering, issue the tokens on the blockchain, and then do the lifecycle management and the integration with the changes for the compliance. If you think on the traditional, let's say, capital markets side, we're kind of like a transfer agent. So typically, an issuer, will go public and will use, Goldman Sachs or someone else to prepare the offering and do the fundraising, and then they'll need a transfer agent, let's say Computer Shares, to be able to manage the compliance of the security, as well as the communication with the investors and the shareholders for governance purposes or dividend payouts, etc. And then they will integrate with exchanges, and they will list their securities on exchanges. So we kind of like this idea of sitting in the middle and just being kind of like a digital decentralized transfer agent for issuers. And this facilitates that we can partner with broker dealers and investment banking services on the initial part of the process, and we can partner with any exchange on this end part of the process, and just sit in the middle, adding value to the issuer.
That's awesome. So, going to that traditional finance realm, do you think that, I always get a question on whether or not security token companies will meet Wall Street in the middle, or if they're here to disrupt them, or what happens to our 7% fees and our underwriters. And the tune I'm hearing from a lot of security token companies is, a year ago, 2 years ago was, anarchist, let's disrupt Wall Street. And now it's kind of like, let's work with Wall Street. I'm wondering if you have any takes there.
I think it depends on what part of Wall Street you talk about, right? So an underwriter, I don't think that is going to be disrupted by this. In my opinion, it might be disrupted a little bit in the sense that some people that might want to use their services today with a security token offering, then maybe they can put out and do the fundraising without using a broker dealer and then the writer or investment banking. But I think those guys playing on that part, they're pretty safe. They just actually going to have a new asset class that they can, work for and they can support. The exchanges might be disrupted because, if the exchanges are trading security tokens suddenly, become much more affordable and much more popular, then, someone like NASDAQ or New York Stock Exchange, they will have to decide, whether they want to start listing those assets as well, or just stay with the traditional assets. So I think there you're going to see a lot of more competition. Not sure they will get disrupted or they will embrace this and take over, but certainly there's going to be competition. I think where disruption is going to happen is kind of in between where we are today. So transfer agent services could be largely automated and decentralized using blockchain technologies, and therefore they're going to cost a fraction of what they cost today. Today, most people don't realize, but if you're a publicly traded company and you want to conduct a proxy vote because it's your annual shareholders meeting and you need to, approve the next budget or the bonus of the executives, or it's not a simple way to do it because you don't even know who your shareholders are, what your cap table is. It's all hidden with the brokers, etc. So usually you will use a transfer agent services to try to do that and then pay, quite handsomely to do that. There's other actors there, like the counterparty risk people that usually live out of managing the risk between the purchase and the settlement of a security, which usually in the traditional markets will take 2 or 3 days, and therefore, there is a risk of the company, the price changing, or the company being acquired or going out of business, etc. And there's commissions there, which with instant settlement on the blockchain will disappear. There is the central depositories, which basically hold all the shares, like like here in the US, DTCC, or others like Euroclear in Europe, etc., that potentially are going to be disrupted as well, because kind of like the role sort of disappears with the blockchain, because with the blockchain, people are holding their own assets and they're transferring the assets instantly, and these traditional roles of intermediaries there that hold securities disappear as well. So as I said, it depends on what part of Wall Street you're referring to. Some of them can actually thrive with this and find something else to do, and some of them can actually be disrupted.
That's interesting. Well, I'm glad I'm focused on research, but
research is great. You guys will have a new asset class to research on, because especially for what I think is going to happen with people like you guys is that security tokens are going to be kind of like publicly traded, but they will not have as much information around those projects and those companies as a properly publicly traded company in Nasdaq. So there's going to be a need for providing research information on companies like Blockchain Capital or Spice to be able to signal to investors whether they should be buying at this price or another price.
That's super interesting. Well, Carlos, I have one last question for you. I've been spending a lot of time on governance and just thinking about the rights of stakeholders in different crypto networks, and this ranges from Bitcoin to projects like Decred and Tezos, where the token holders actually have a say in the platform, and as holding tokens, not just through mining equipment, et cetera. But one of my questions for you is, within your lifecycle management platform, do you see a future where security token holders will have governance features, like if they want to vote on a change to a building, or they want to vote for a baseball team that's securitized to trade a player? Do you foresee this happening?
I think definitely some sort of governance rights needs to be given to security token holders, because otherwise the institutional investors will not enter the space. Like today, if you look at most of the security token offerings out there, they're just offering common stock, no voting rights. And then a lot of people don't want that, right? So they want to have more complex rights, like right of refusal, liquidation preferences, and voting rights. Now, so we have an opportunity to be able to implement those on the blockchain in a very transparent way to provide to the token holders. And I think because the tools are not there, most people issuing security tokens today, they just opt for a very simple thing of saying, okay, I'll just remove all these things and issue a very, very simple, like, common stock representation on the blockchain, and that's it. But I think governance needs to be there. And I think the blockchain actually and security tokens will allow for new ways of governance that are very difficult to implement today. And I'll just give you one simple example. So today, if let's say Facebook wanted to reward, the people that have been holding Facebook shares the longest, and then conduct a proxy vote and say, okay, if you've been holding the, Facebook shares longer than another, your vote actually counts more than another vote, because, we want to kind of give you more weight to your opinion because you've been holding our shares for long, which, makes sense, right? It would be impossible for them to implement it, literally impossible, because first to start with, they don't know who holds their Facebook shares, because they list, like 3,000 shareholders, a company that's worth 600 billion. So obviously it's not true. It's just simply that they don't know who holds the shares, because the brokers register the street name is called, and then this, millions of shareholders that are not visible to the parent company. And second, with the different, systems that are being integrated, there are different places where things are being traded, different brokers that are holding the shares and things like that. It will be impossible to actually, create this weighted voting system. On the blockchain, this is to some extent trivial to implement, right? Because you have the whole transaction history, so you actually know how long that token has been sitting on a wallet that belongs to the same person. And then you can just run an algorithm and calculate that, and you will immediately have, the weights of the votes according to how long you've been holding a security. So I think that, governance needs to come, and we'll probably see more interesting governance models because of blockchain than the ones that have existed so far.
That's interesting. Carlos, last question for you, I promise. It's on regulation. And I'm wondering here, I've spoken to security token companies in the past. I believe it was on my podcast with Harbor, where Josh Stein told me that basically they don't need any regulations to change because everything they're doing today is legal and is covered by current regulations. Are there any regulations that you guys could be subject to in the future, or you need passed, or is everything okay today?
So I agree and disagree with Josh. I think that I don't know what he meant because I'm here on the podcast. But
don't totally quote me. I'm thinking several episodes.
Okay, so let me just give you my personal opinion. I think that the good thing is that you can operate legally in the market without a regulation change because you just follow existing regulations. And that's it. And that's great, right? So as opposed to a completely different asset class, like, I don't know, like Bitcoin or Ethereum, etc., or the ICOs when they started, that required the regulator to give an opinion. Here, this is just digital securities, right? You're just digitizing securities. You happen to use a distributed ledger technology to digitize them instead of a centralized database. But from a regulatory perspective, this is just a digital security, which is legal to issue. So I think you can just start operating legally by following existing security laws in the different jurisdictions. And that's great. And this is why I think it will allow this industry to grow without waiting for the regulators to do any changes. That said, I think there is a number of things with respect to the current regulatory environment that will be great if they were reviewed in light of what security tokens can do on the blockchain. And some of them are, everything has to do with how transfer agents or central depositories work, which is fundamentally changed and disrupted because blockchain technologies and instant settlement and things like that. So those regulations were designed for a different underlying technology and underlying scenario. In Europe, for instance, you have to use a central depository, but you actually don't need a central depository for once you do blockchain. So here in the US, if you're a transfer agent, you have to register the fingerprints of the people working with you because they're supposed to be touching the paper certificates, which is obviously something that doesn't happen anymore. So I think there is a lot of things that have to change. And then there's other more like, if you want, philosophical things about today. Securities in most countries are kind of restricted to wealthy people. And that definition of wealth is different from country to country. And in some countries, it actually limits who can actually hold the security quite a lot because the threshold is very high. Like I was in Israel last week, in Israel, the threshold is extremely high. So I think if considering that the market is, the wealth in the last 20 years has been created in the private markets, I think regulators will do a good to the society if they were considering on allowing more people to participate on private placements, which is something that actually security tokens can facilitate. And for that, they need to lower the bar of who can participate there or not. So that's another example of something that, it'd be good if it evolves over time. And also security laws are convoluted. So there's sometimes like an exception of an exemption of an exemption that makes it very difficult to understand exactly what you can do, what you cannot do. So more clarity, simple rules, etc., will also facilitate how these things get implemented and traded. The option of actually having some sort of unified view across countries, which I know is very difficult, but that will also facilitate that this becomes a global phenomenon, etc. So to summarize, yes, you can operate with existing rules today legally, no problem. But I think there's a lot of things I can think of that if they change, will facilitate that this market gets bigger.
That's awesome. Carlos, you share so much information. I feel like I should be paying you as a consultant.
No problem. I should thank you for giving me the opportunity.
I appreciate it. Well, Carlos, it's been a pleasure having you on. Is there anything that we missed that you want to talk about that I didn't ask you about?
No, I think it was an extremely complete set of questions.
Awesome. Well, Carlos, thanks so much for coming on.
Okay. Thanks to everyone.
Hey, everyone. Thanks for listening to the episode. Please rate and review the podcast to help other people find it. And be sure to use coupon code HOLIDAY on 51pct.io to get a discount on any of our memberships while this offer lasts.